And the next section is another highlight of today's event. Here with us is the founder and managing director of Asia Research and Engagement and Special Risk Consultant of Asian Corporate Governance Association. He is an expert in providing institutional investors with responsible research services. Today, he will address the role of sustainability reporting and how it relates to responsible investment. And please welcome Mr. Benjamin McCarron.
Sawadee Krap. Thank you, Chairman. Thank you for the opportunity to speak today about a subject which I find very interesting. While we're waiting, I'd like to tell you a short story from last week. I went to Jakarta. I was in the airport in Singapore, and I went into the bookstore, and I saw this magazine, Fortune magazine, a business magazine about making money, about profit, about wealth. Let me read you the cover page. Change the world. It's not very capitalist, is it? Let me read you the rest. It'll make sense. Our first ever Change the World list. Nike, Cisco, MasterCard, SAB Miller, Vodafone, Google, and 45 other companies that are doing well by doing good. This is a list of companies making money from their sustainability programs, which is very much the subject of the talk I'd like to present today. So I've already been introduced. I work in Singapore with Asia Research and Engagement, my own business, and I also work as a specialist consultant with the Asian Corporate Governance Association. So making money and sustainability, and why we should think about it in this way. If we understand that this is about better turnover growth, better risk management, operational savings and productivity, the whole question of should we do sustainability or is it a cost, that question goes away. So that's why it's really helpful for companies to think in this way. I'll go through the studies that are available on the business benefits first, and then look briefly at what is corporate sustainability. I won't be too theoretical. This is mainly a practitioner study. The organization of the case studies is by value driver, so thinking turnover growth, risk management, productivity improvement. Other ways of presenting case studies are by issue. Then you think human rights, water saving, energy saving. Or another way is by sector, autos, banks, and financials, for example. But here is the value driver. Then we'll turn to the essentials of good reporting with a little about communicating with investors before concluding. Here is the first set of studies. An investment manager called Arabesque did a review. They worked with the Oxford University, and they reviewed 190 different studies, papers, journals, articles, and they were looking for the economic relevance of ESG. And they categorized the studies into different types. So cost of capital studies, operating performance, and stock price. And you can see there, the overwhelming majority of studies find that there is a beneficial link between ESG performance and cost of capital or operating performance or even stock price. Let's look at one study in a bit more detail. This wasn't included in the previous list. It's a Harvard business study. It came out in March of this year. And the study really is looking at the difference between material factors, the ones really important to business, and the less material factors. So this first column here looks at the business's performance on immaterial factors, those that have weak performance on the immaterial ones. And this row, the top row, looks at the material factors. The definition is by an organization called SASB, the Sustainability Accounting Standards Board. It's mainly a US body, but the conclusions on what's material are applicable globally. And what we see is the companies that focus on the material issues and don't focus on the immaterial issues do really well. That's stock-specific outperformance, 6% annualized. So what do we mean by corporate sustainability? I tend to try to use a quite sort of simple definition and have 3 levels. There's 3 levels, but you can see there's 4 labels. So the first point is philanthropy. Philanthropy is really good. I don't want to say anything bad about philanthropy. But philanthropy is doing something after the profit has been made. And corporate sustainability is about how the business makes money, not what it does afterwards. So philanthropy, it's good, but it's level 0. It's not on the journey. The other thing is that for every business, it's a journey, where you're starting now, you start the sustainability journey, and then you progress on it, up this kind of chain, these kinds of steps. So level 1, what's the difference between community investment and philanthropy? Community investment is where there are, okay, donations, there are charitable investments, but they are aligned with business strategy. For example, a mine. A mine has an operation, it builds a school, it builds a hospital, and the local community can go to the school and the hospital. Why? Well, maybe something happens a few years later. There is some problem with the mine. These things happen. If the company has built the school and the hospital, and the community likes it, the community will be patient if there is some accident. If the mining company has not taken that trouble, the community can become very angry and they can close down the mine. Actually, we're going to see an example later of a community that got angry in that kind of way. The next level, corporate responsibility. For corporate responsibility, the company is thinking about its own operations, its factories. Are we being efficient? Are we saving energy? Are we saving water? Are the staff happy? These are very positive, useful things for a company to do. Also in corporate responsibility, there's consideration of the supply chain. Do we have child labor in our supply chain? Do we have slave labor in our supply chain? Corporate responsibility is about managing all of those impacts. But is it sustainable business? Sustainable business is one step further. It's where you look at the life cycle of all of your products and services. Look at the materials from the beginning, right with the suppliers, all the way through your operations, through the customer, into the customer's value chain, and beyond what happens with the customer. And think about the raw materials relating to that, and the people and how they are affected relating to that. Looking at impacts and dependencies, and then moving the business to lower impact, lower dependency business lines. Lower impact, lower dependency products and services. That sounds quite challenging. It is quite challenging. But this isn't theory, it is practice. And in fact, I took this, I adapted those levels from a company, Marks and Spencer's. Do you know Marks and Spencer's? So, okay, that's good. I thought so. I know Marks & Spencer's in Singapore very well. In fact, I'm wearing Marks & Spencer socks today. So they went through this journey, the 1980s. They started with philanthropy, 90s, corporate responsibility in 2000s. And then in 2007, they launched Plan A, 100 commitments about how they would treat their suppliers, about their energy efficiency, about labor practices, both in their own operations and up in their supply chains and the communities. Sustainable sourcing standards, 100 commitments. It went so well that in 2010, they launched another 80 commitments. And in 2015, this year, having met many of those commitments, they've refocused on 100 in Plan A 2020. So they feel that they are well on the journey. They don't think they're there. They still think it's a journey, but they're on that trajectory. And we're going to come back later to look at some of the results of that in financial terms. So now to look at these case studies, starting with turnover growth and innovation. Can we really grow the business through looking at sustainability? Here's some examples of some companies that have. General Electric launched Ecomagination, their sustainable business unit, effectively, in 2005. They started by spending $5 billion in research and development. It went so well, they spent another $10 billion, so $15 billion of research and development expenditure, creating $200 billion of revenue over the last 10 years. They thought when they started that it would probably grow at about 2 times the rest of the business. It's grown at 4 times the rest of the business. What are they doing? So they're helping their customers by, for example, in aviation, more efficient software that helps planes land more efficiently, and in freight planning services, similarly. And then also they have great hardware, so turbines for wind power generation, and also in aviation turbine technologies as well. Another example, Philips. Philips is a healthcare, lighting, and consumer lifestyle business based out of the Netherlands. And they're pioneers in what's called the circular economy. Circular economy means we shouldn't really think about waste. Waste should be an input into the business. They have now, that 11 billion euros of turnover is actually this year, it's about 52% of their total turnover. They are transforming their business into one which is primarily selling, they've already done it actually, they're primarily selling green products. Dow is another example, selling $13 billion of sustainably advantaged sales. We'll look at that a little bit more, in a little bit more detail. This is not just a global MNC phenomenon. Toyota is also up there, an Asian company. And then from Southeast Asia, I selected the example of Bank Rakyat Indonesia, or BRI. You may know this business. Actually, this isn't so much about new growth in the case of BRI. It's the largest private microcredit institution in the world. Actually, I met them last week. They're very proud. I think they're also the first bank to launch a satellite. They've found that by providing satellite banking services, they can do it more cheaply. 32% of their loan book is in microcredit. People think that you can't address the bottom of the pyramid with sales. You can't address inequality at the same time as growing business, partly because people at the bottom of the pyramid don't have so much money. And yet, BRI is a very large bank, and the core of its business is addressing that. So let's look in a little bit more detail at Dow Chemical. And they thought, okay, we're going to invest in this product line. They actually had a difficult history in relation to chemical spills, and perhaps that in a way helped them think, okay, how are we going to address this? They had a commitment that 10% of their turnover should come from sustainably advantaged sales by 2015. As you can see, it's 22.4%. It's well exceeded their commitment. They found it's just grown much faster than they anticipated. A couple of examples of their technologies. They work with Unilever's Lifebuoy soaps, which soaps, of course, are sanitation, so that's a good right there. But the soaps are longer lasting. They don't break down. So, you know, they don't sort of melt in the bathroom, which we are all familiar with. Another example is Betamate, which is a way of chemically bonding different materials together. This is used in the automotive industry, and it reduces the need for welding. Welding is, of course, a very energy-intensive way of bonding materials together. If you can glue it instead, that's a lot of energy saved, a lot of CO2 saved. So that's the example of Dow Chemical. And Toyota will all be familiar with the Prius. And it took, so launched around 97, it took nearly 10 years to sell the first million. And now look at it. That's a fast growth curve. Over 40% of Toyota's unit sales in Japan are hybrid vehicles. They're targeting over 50%. If you're competing with Toyota in Japan, you need to have a competitive response to the hybrids. Even if you don't believe in sustainability, you need a competitive response. And if you're supplying Toyota or the Japanese auto industry at all, and of course there's many Thai businesses that do, then it's important in terms of future growth to get designed in to these kind of vehicles. Sustainability thinking will help you to understand customer innovation. That's the general lesson from that one. So let's look at a different subject, a different value driver, risk management. And partly because I was asked to look at human rights, I've got an example from human rights. It's an interesting subject because human rights, usually it's very hard to find quantitative numbers. It's a very qualitative factor. But there was one case that I'd like to share with you on community and license to operate. So that's Vedanta. We'll come in a moment. But risk management, we can think of different areas. There's community license to grow, safety. Safety splits into operational safety, when we think of the BP oil spill, or we think of TEPCO, the nuclear incident in Japan, or food safety. And Nestle, of course, have been having problems managing their noodles, Maggi noodles recently. We can also think of risk management in terms of investment or banking, and ESG screens. We'll be listening to a fund later on that today. I'm looking forward to it. But I've got an example, again from Indonesia, I'm afraid, on that coming. So, human rights. This is an example of a company that picked the wrong battle. Turns out these guys were not to be messed with. Vedanta is a large minerals, metal company. It's an Indian company, part of the Sterling Group. Vedanta's listed on the London Stock Exchange. And they were in Odisha, a state in the north east of India, and they saw these hills, the Niyamgiri Hills, made out of bauxite, aluminium ore. Vedanta thought, fantastic. They set up a big smelting plant. They spent over $8 billion putting a smelting plant next to these hills. However, the Dongria Khond, and you see some of the Dongria Khond pictured here, they revere these hills as their god. As far as they were concerned, this was the god. Vedanta was not going to come along and take their god away and turn it into aluminium. So they, well, it was a long fight, really, about whether or not licensing was going to be granted to extract the ore from the hill. And at some point they said that they were going to fight to the death. So I had a slight personal story which I'd like to share on this one as well. I was an analyst at the Cooperative Asset Management in the UK, sort of 2009, 2010. And one of my friends asked me, what are you doing? So I sort of talked, among other things, about this story. And she said, that's terrible. They can't take their hill away. They can't take the God away. That's awful. You know, she's a very nice person. She's a primary school teacher. Anyway, so sort of went back off to the asset manager that I was working at. I saw her again 6 months later. And she said,